Hey everyone, me Kevin here. Is it time to buy Peloton? Well, let's talk about some pros and some big risk factors that we have to address. We're talking about Peloton and Peloton Stock. Obviously, Peloton crashed after their last earnings. Peloton has been on a very, very strong downtrend, and it has not been very good for shareholders. This is a company that has previously ran well into the 100 plus range, 130 plus range. I mean, this was a darling of the pandemic, and people loved buying a Peloton. But when you look at the day chart for Peloton now, it's just not that great. You saw that 171 peak over here in February, and folks, since then, it has been a bleed out essentially for Peloton. We did hit a temporary low over here in May, but after the last couple earnings, we just went down and down. Now, I did sell out completely of my Peloton as of somewhere around $113 is when I completely sold out. Which, remember, anytime you want to know exactly what I'm doing, you can check out those programs on Building Your Wealth down below, where I give you an update on things that I feel in the market, or companies I'm researching, or companies I'm thinking about selling or going heavier on. Anyway, yeah, Peloton, I sold it before the earnings, the September earnings cycle. And the reason I sold it then is because I started noticing declining search trends, declining website traffic, and the nail in the coffin for me was when Peloton started reducing their prices, as well as at the same time, their delivery timeframes were falling while we were in a supply crisis or a shipping crisis, which is weird because you would expect that shipment times would go up if there's a shipment crisis. So the only reason you would have shipping delays but then actually see shipping timeframes go down for a new Peloton bike is if demand was substantially lower and Peloton was essentially trying to get product out of inventory or off the shelves, so to speak, and they weren't so reliant on waiting for manufacturing. So these were really big red flags, and we've seen these red flags developing really for many months now. In fact, if you take a look at the Google search trends for Peloton, you've kind of been seeing this downtrend virtually all year. And so if even if you had sold, or even if you had looked at some point here in the summer, you would have seen the declining trend. Now we've kind of flattened out at this relative strength around 30 to 38 here, but obviously this is substantially lower than where we were. If we go back, really I just want to see the last couple of years here, but I'm going to zoom out. Obviously the pandemic bump, very substantial. This is 2019 over here. Pandemic bump was a little bit right around here is where you kind of had the pandemic bump. People really wanting to work out as the pandemic lasts longer. So we've obviously come down from the pandemic lows. We're still higher with a search interest of about 24 than where we were previously with search interest around 10 to 12. So trends are certainly up, but the stock price is also way up. Now, in fairness, Peloton did IPO last year, but the stock price is way, 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 way up from where it IPO'd. Remember, it IPO'd for right around $27 per share. It did fall as low as $19 a share during the pandemic, which was pretty crazy. That we did fall so low. Actually, it was $17.70 is how low it actually fell there for a brief moment. Take a look at that. But anyway, and it did IPO shortly before that. But what's really important now is asking, okay, are we in a position now where it makes sense to buy Peloton again, or are there too many risks that are still sort of written on the wall that we need to be aware of? And why is the stock running so well today? Well, the stock's running today because the company disclosed that it is selling 23.9 million shares, which would usually lead the share price to go down, but it's actually going up because a buyer was already located. These aren't 23.9 million shares that are being thrown onto the market to essentially increase supply, and anytime you increase supply, when demand remains constant, price goes down. Very simple. PQ, this is what you learn in Econ 101. Now, the shares were sold at $46 per share, which was a little bit less than where the stock was this morning, but it really served to create kind of a floor for the market, and I believe that's why the stock is rallying about 12% today. You've got the stock up 12% today to $53.20. It did have a low yesterday of $46.70, and these shares were sold at $46. And I believe that this $46 purchase has really created a support level for the stock. And that's why we're seeing this 12% bump today, because folks are thinking that, okay, that's it. We're not going any lower. See, yesterday when we hit 46.70, I believe the market was pricing in the risk that Peloton stock could fall even lower, that it could fall into the 30s. And so you had a lot of hold on sort of buying activity. Now that you had a big buyer come in, essentially $1 billion worth of shares being bought, it's like $1.7 billion. But anyway, billion. 1.07 billion. There you go. That's the correct number of how much money this raises for Peloton. Now you've essentially created at least a strong support line here at 46, because that's clearly where somebody was willing to buy essentially $1 billion worth of Peloton stock. And I think that's why Peloton's running right now. But what we've got to know here is, what could Peloton potentially do with the money? What pros are there with a Peloton? And then what risk factors do we want to pay attention to if we're going to actually invest in the company? So pros, Peloton's going to be using this money to expand their facilities and maybe even use it for acquisitions. Now, Peloton has already been planning, according to their latest quarterly report, they're already planning on spending about $500 million on new infrastructure for their facilities, developing probably their Precor partnership. Precor partnership, by the way, we're really excited about that. Remember, their Precor partnership is not even so much a partnership. It's Peloton full-on bought Precor. They make gym equipment that you usually see at hotels or gyms. It's high-quality gym equipment. Peloton bought them for around $400 million. I thought it was a steal. And it really lets Peloton get into so many different verticals. I mean, think about it. They could get into the elliptical machines. They can get into rowing machines. They can get into strength training machines, which strength training alone is such a huge opportunity for Peloton to have connected fitness in strength training instead of just yoga or biking or treadmill or whatever. Now, strength training, that in my opinion is a huge opportunity, especially if you can get machines in people's homes. Think about like a connected fitness Bowflex or something like that at some point in the future via Peloton. So a lot of optimism for the Precor partnership. The company did have about $600 million in cash. They've got some extra marketable securities as well. But if they're planning on spending $500 million, it kind of makes sense. They were going to start blowing through cash pretty dang quickly, especially since their free cash flow is negative because they just lost over $370 million in this last quarter, and that is not good. So while I'm very, very optimistic about this Precor partnership, I'm more concerned about some of the other things and other trends that are happening at Peloton. And unfortunately for me, those negatives probably outweigh the benefit and the potential of what this $1 billion and investment by Peloton into their facilities and manufacturing, and maybe even for acquisitions or other developments with Precor could actually bring to the stock. And so this is what we're going to have to talk about now. And those are the cons, okay? And it's also, I suppose, another pro would also be that, hey, look, we've got a New Year's resolution cycle coming up. That is often good for fitness companies. We also have the hope that once we fully get out of the pandemic and any traders who are in the stock kind of riding it as a stay-at-home trade get out of it, and we get to a more neutral market, that maybe we'll see less volatility and less pain towards the downside, which could be good for the stock. But in the meantime, you've got some other bigger problems to worry about than this going from COVID stay-at-home darling to not. And those begin with Churn. Okay, let's take a look at their latest financial report, and we're going to get an update on their churn numbers here. So if we go ahead and look at the churn numbers, we're going to see that as of September 30th, 2021, they had churn of about 0.82%. Now, you'll notice that's higher than the 0.65% on a monthly basis that they've had since 2020. And the reason this is a little bit concerning to me is when you divide these numbers by each other, you'll find out that this is an increase in the churn rate of about 26%. Now, churn is still relatively low. You'd have to compound 0.82%, but we're to really get a figure in terms of how many customers you might lose annually. So, but if we do just a rough approximation here, you're somewhere around 9 to 10% of customers that you're losing on an annual basis. And this is probably expected for the connected fitness world, somewhere around a 10% annual churn. But The problem here is Peloton used to cheer itself on its extremely low churn, and to see churn all of a sudden increase 26%, in my opinion, is a little bit problematic, especially since we're also going into sort of this new reopened world. The last thing we want to see is all of a sudden churn adjust to very high levels or higher levels than where they previously were and not actually come back down. So I don't like this transition in churn. 26% is definitely a lot of an increase for a churn. In addition to that, we've got a few other things that also, in my opinion, create a few little problems. Declining workouts and advertising efficacy. Let's talk about both of those. So declining workouts, I thought this was interesting. Now, this could just be a representation of less people being home as much. But in 2020, you had 77 million workouts, which came out to, or calculated out to, about 58.3 workouts per user, which I actually thought was a lot when I first saw about it. I noticed that. See, it's average. That's not the average monthly workouts. Rather, this is the total workouts in millions, right? So you get 77 million workouts divided by 1.3 million people is how you get to about 58.3 workouts. So that's about an average of a little over one a week, right? Well, that average has declined about 17%. Again, this could be because people are going back to work and they're not home as much, but it's still a metric to pay attention to. And so we'll notice here that in addition to this churn increasing, we're now seeing workouts at about 48.3 per connected fitness account, as opposed to that 58.3 we previously had. So a 17% decline in workouts. And on top of that, we're noticing some pain in advertising efficiency. And this makes me particularly concerned. Now, one of the reasons that was talked about in the earnings call was that the Apple transparency upgrade, where Apple has made it more difficult for advertising companies to target their customers thanks to new privacy rules on Apple devices. So in quarter 2 of the 2021 calendar year, Peloton had 655.3 million in connected fitness product revenue. 655.3, right? But in the very next quarter, we fell to 501. That's pretty dang low. That's not good. That's a big decline. That's a big decline quarter over quarter, and it's a decline year over year. So both ways you slice it, you see that connected fitness product revenue going down, which is a sign that the advertising efficacy is declining. But not only can we see that advertising efficacy must be declining because all of a sudden product revenue is going down, advertising costs are actually going up, which reiterates that advertising efficacy is going down. See, in 2020, we spent $108 million on sales and marketing. I'm sorry, sales and marketing was 114. Divided by 601, that works out to about 19% in terms of how much they spent on marketing compared to the revenue they got from their connected fitness products. So for every $100 of product revenue that they made, they spent $19 on advertising. Well, for every $100 that were spent on products at Peloton in 2021, we now spent $56 on ads. That's huge. Spending $56 per $100 on ads compared to the $19 you used to spend. It used to be, you used to have effective advertising. Now you don't. Whether it's blaming Apple or it's because consumers are saturated or because people feel like they're aware of Peloton, the people who wanted it got it, the people who don't want it aren't getting it, and the ads aren't convincing them. Whether it's because Peloton believes that their product is branded maybe too much as a luxury product, which is something that they mention. See, right here, top line, the perception that Peloton is a luxury item. We intend to amplify the platform's value proposition. And really, they're trying to attract younger people with potentially less net worth to try to get into the Peloton network. But so far, their advertising is failing. Now, you might think, oh, but Kevin, their advertising was so much more effective during the pandemic because you could sell anything during the pandemic. It was a pandemic. It was easy to sell stay-at-home fitness equipment. Maybe that totally might be true. And in fairness, for the 3 months that ended September 30th of 2019, we ended up seeing connected fitness product revenue of about $157 million. So obviously, we're way up from there. And they spent $77.6 million on marketing, which works out to about $49 for every $100 of revenue. So we've seen these larger numbers before, but the problem is we're going from really high numbers of advertising per dollar of revenue to a low during the pandemic, and then not up to where we previously were, but worse. We're now spending more money per dollar of revenue than we did even in 2019 when the company was less known. And again, you could make the argument that, well, the company was less known, so it was easier to sell back then. But wait a minute, the more you have a network effect of more people using Peloton, the easier it should be to sell. Like ultimately, I want to be investing in a company where it's easier for them to sell, not harder for them to sell. And right now it's becoming harder for them to sell, not easier, especially even compared to 2019, which in my opinion, that's a problem. And that's not good. In addition to this, because they continue to reduce their prices, their margin is substantially being impacted right now. And I know this is a lot of bad news right now, but it's the reality that you got to be aware of if you're investing into the company. So their margin has fallen substantially. Back in 2020, their gross profit per $100 of bike sales or tread sales or whatever was about $39.5. So if they had $100 of revenue, they took 39.5 of that as gross profit before things like sales and marketing and their general and administration and their research and development and their taxes, right? So $100 in for the bikes, they'd keep 39.5 before they got to the other expenses. So cost of goods sold is what we're subtracting there. Well, now for every $100 they're taking in, they're only keeping $12 before they get to sales and general and administration and research and development, which they're spending way more on those things now. So it's no surprise that all of a sudden the company's losing $376 million. It's because they're spending like crazy. They're not getting the product sales anymore, and their product margin is plummeting because they're having to lower prices. These are all not good things. Here's an example for you of how the math would look. So they mention over here that their margin decreased substantially, and that was primarily due to the decrease of their bike price from $18.95 to $14.95. Okay, so let's understand this. If at $18.95 they had a 39.4% gross profit margin, then that would leave them with about $746 for every bike they sold. Now, drop the price $400, take that $400 off of their margin. Now they're only making about $346. $346 divided by the new price of $14.95 means their margin's probably somewhere around 23%. It's a little bit lower now at 12%, so because of supply chain issues and logistic expenses and stuff like that, as they've mentioned here. So we do expect that margin to come back up. It's not going to be 12% for forever. We expect that to come back up, and it really needs to, because otherwise they'll never go profitable. But still, 23% gross profit is substantially less than that 39.6 we used to have. 23 divided by 39.6 is a reduction of about 42%. It's a 42% decline in gross margin, and that's not good. Having to reduce the prices to these levels makes me worried that Peloton soon is just, unless they innovate with some new products and they end up convincing people to use their products, Peloton might end up becoming a SaaS company, which is really weird to say because obviously they're a product company that also sells a service. They have the trainers, they've got great service or great software. But the problem is, if we end up with zero margin on the hardware and we're really just trying to get subscription revenue, fine. How quickly are we able to grow subscription revenue? Well, if we compare year over year, for a company that's valued pretty highly, I mean, it's a $16 billion company. In the grand scheme of things, it's not extremely expensive compared to maybe other companies that are $50 to $100 billion, right? But for a $16 billion company, we'd want to that has no revenue. We'd want to see some substantial growth, right? And we used to see substantial growth. We used to see a lot of growth. But take a look at this. If we look at the subscription revenue, subscription revenue, very, very important. We are at 304 right now in millions of connected fitness revenue. We used to be at 156, so that's pretty good. That's a 94% bump. So that is good. We want to see that, okay? That's very, very good. Now, if we compare this to the good old days, well, we'll take a look at this. We saw subscription revenue double in 2018 to 2019 from 31 mil to about 67 mil, a little bit more than a double. So this is good. We're still growing that subscription revenue at a high pace. So I do like that about Peloton. The question, though, is how long can we maintain this? Because now, if we have subscription margin somewhere at about a third, see, they spend about $33 for every $100 of subscriptions that they have. In order for them to become profitable, they're really going to have to get their sales and marketing, their general administration, and their research and development costs. They're going to have to get all of these down substantially, probably under 40%. So that way, if you are selling hardware at break even, you're under 40% for your operating expenses, and you're at, say, 30% in expenses for your subscriptions, well, then at least maybe you've got some money left over to actually turn a profit for shareholders. But right now, the biggest concern here is a slowdown in the hardware sales, which could potentially end up leading to a slowdown in the amount of people signing up for subscriptions for Peloton. So far, we're still seeing good growth, and this is exciting. I like that we're seeing good growth in the subscription model because it could mean that a lot of people are using the subscription service without actually having the Peloton hardware, which is fine because, again, the subscription is much higher margin, taking 70%-ish to the bottom line or to the gross profit line, rather, which is great. But again, how much in sales and marketing is Peloton having to push to get people to sign up for this for these subscriptions? And is churn going to continue to increase? So, bottom line, does it make sense to invest in Peloton? In my opinion, I'm not enthusiastic about the risks that we have here. The risk reward is skewed for me. I do not like that churn is increasing. I don't like that advertising efficacy is going down. I do like that subscription revenue is still exploding. I mean, we still doubled year over year coming out of September of 2020, which is great. But there's some serious concerns in terms of how long is that sort of growth going to last? Is churn going to continue to go up? And what's it actually going to cost us to where are we just losing money to try to acquire customers? And that's the issue. Because even though we saw a doubling in the subscriptions, we also saw a more than doubling in sales and marketing. In fact, if we take 284 million divided by 114, we 2.5x'd our marketing spend, but only 2x'd our subscriptions. So again, back to that advertising inefficiency, whether they blame Apple or it's because the market's saturated and people just aren't interested in Pelotons right now, I don't know. This is not a stock that I'm in. It's not a stock that I'm going to buy the dip in. Would I maybe play options on it? Maybe. But beyond that, maybe selling puts and trying to farm some higher volatility. Beyond that, not a stock I'm interested in. These are my thoughts on what's going on with Peloton. If you found this helpful, check out my programs on building your wealth down below and the Stocks and Psychology of Money group, where you learn how to take a look at companies the way I do. And folks, we'll see you in the next one. Thanks so much. Bye.